So, what if I told you there's a company out there that has grown its profits every single year for the last 15 years? Yeah, through all the recessions, market crashes, everything. And you've probably never even heard of them. They're called Lagercrantz Group, and their secret, really, is a machine. To understand it, we've got to start with just one number. 15. That's 15 straight years of increasing earnings per share, through the good times and the bad. I mean, this isn't just good. This is absolutely world-class consistency. It's the kind of performance that makes you just have to stop and ask a really simple question. How is this even possible? Is it some blockbuster product, a crazy streak of luck? Nope. The answer is way more interesting than that. It's a system, a literal profit machine built on a really unique philosophy. So let's pull back the curtain and see how this thing actually works. Okay, so the first thing you need to wrap your head around is that Lagercrantz isn't really one single company. It's more like a holding group, a collection of about 85 different independent businesses. And each one of these is a leader in its own little technology niche. This diversification, that's the bedrock of its stability. Their whole strategy is called buy and build. They go out and acquire these fantastic little tech companies, and then they do something kind of radical. They pretty much leave them alone. Instead of meddling and micromanaging, they operate on this principle of accountability and freedom. Basically, they give great managers the autonomy to keep doing exactly what made them great in the first place. And this, right here, this is their killer advantage when they're out there trying to buy companies. They promise entrepreneurs evolution, not revolution. I mean, think about it for a second. If you've spent your entire life building a business from scratch, are you going to sell it to a private equity firm that might just strip it for parts? Or do you sell it to a permanent home that will protect your legacy? It's a no-brainer. And this promise gives them first dibs on the best companies out there. Now, these 85 companies aren't just random, no. They're all organized into 5 really strategic divisions. Just look at the names here: Electrify, Control, TechSec. You can see they are deliberately targeting the biggest, most durable trends for the next decade. We're talking electrification, automation, security. So it's not just about spreading risk. It's about concentrating their bets on what they see as unstoppable growth trends. So they've got this brilliant structure for buying up great companies. But how does that actually make money for shareholders? Well, the magic is in their value creation formula. And honestly, it really just comes down to 2 surprisingly simple ingredients. All right, the first ingredient is this powerful financial concept called multiple arbitrage. And put simply, it means they buy great private companies for a cheap price, usually around 6 to 8 times their annual earnings. But that's just the first step of the trick. And here is where the magic really happens. As soon as that small company's earnings become part of the publicly traded Lagercrantz Group, the stock market values those exact same earnings at a much, much higher price, somewhere around 25 times. They are systematically buying dollar bills for, let's say, 40 or 50 cents, and the market almost instantly reprices them to their full value. That is pure structural value creation right there. Okay, the second ingredient is their operational secret weapon. It's this metric they live by called P/WC, which stands for return on working capital. Now, think of working capital as just the cash a business has tied up in its day-to-day stuff. This metric forces every single manager across all 85 companies to constantly ask one question: how can I generate the most possible profit using the absolute minimum amount of cash? And the results are, well, they're stunning, as you can see here. Their own internal target is an already crazy ambitious 45% return. But in reality, they're hitting 75%. This isn't just some number on a spreadsheet. This incredible efficiency generates a ton of free cash. And what do they do with all that cash? Well, they use it to fuel the machine, to go out and buy the next great company, starting the whole amazing cycle all over again. So we've established this machine works brilliantly. It produces these incredible, world-class results. But as an investor, you always have to ask the next question: what's it going to cost me to own a piece of this extraordinary performance? I mean, the numbers really do speak for themselves. You're looking at 16% annual profit growth, super stable high margins, a crazy 30% return on equity over the last 12 months. Oh, and the business is mostly built on proprietary products they own. By pretty much any measure, this thing is a financial fortress. But here's the catch. The market knows exactly how good this company is. As you can see here, the stock's valuation has just soared 5 years ago, you could buy in at around 16 times earnings. Today, you're paying around 26 times. That's a 63% premium. The secret, it would seem, is officially out. And this brings us right to the core dilemma for any investor looking at this today. You've got this phenomenal business, but it comes with a really premium price tag. So before you'd ever make a decision, you have to seriously weigh the key risks. And there are 3 big ones to think about. First, that growth engine we talked about, it's heavily dependent on finding new companies to buy. Second, while it's diversified, its businesses are definitely not immune to a big economic slowdown. And third, to keep fueling all these acquisitions, the company has taken on more debt. It's not crazy high, but it's sitting at around 2 times its annual earnings now. Which leaves us with the final and really the most essential question. We have a proven A-plus quality company with a compounding machine at its core, but the market is now demanding you pay an A-plus price for it. So the question is the guaranteed quality of this machine worth paying that premium for? Well, that's the question every investor has to answer for themselves.